Well, good afternoon, everybody. I hope you had a useful and productive day. More or less. Everybody happy or not? Raise your hands. That's what you call crowd behavior. Anyway, we'll have some time to discuss. The last time we were in Singapore, if you remember, I had a wonderful time in Singapore and visiting some countries around there. And then we said it might be a good idea to go to one of our research centers, and here we are in Port Sunlight. Now, in hindsight even, and with the benefit of hindsight, I also think it's a good idea to actually be in Port Sunlight amongst all of our research centers. As you know, we have 6 of them that we're proud of, and then some smaller satellite ones, but 6 big ones. But this is where it all started, and I think in a time of surprises or volatility, and every week or every month, another one that we did not foresee and have to deal with, it actually is even more important and more relevant to go back to the roots of this company, what made it great. It's also a good reminder for ourselves, what are the things that built this company as we make some of the changes. And we're again in the midst of one of the biggest change efforts in the company that undoubtedly you've picked up some of that during the day today. And I'll refer to that in a minute. Before I do that, I just wanted to go through the different stages of explaining to you why it's right, what we feel it's right, what we're doing right now, and why we are doing this. You obviously have to understand a little bit the steps that we've come from. Some of you will be familiar with that. For some of you, it might be new. So if you permit me, I'll just take you through those stages and then talk about the bigger change, and then probably open it up for the last half hour or so for Q&As or anything you want to talk as usual. And we have here all the other ULE members there that you've seen today, so I think we have a good group to deal with that. The first thing really that we have to go back to is, in consumer goods, we've had lots of discussions about other companies and strategies and our history, but there is one thing that you have to firmly believe, that if you want to grow value long-term for your shareholders, for society, you have to be able to grow your business. Increasingly, you have to be able to grow your business, but also do it in a responsible way. I think that goes by itself. A business that goes down or is under pressure, or even brands within a business that are down or under pressure, it's very difficult to create long-term shareholder value. You can get away with it for a few years. You can fool yourself or others by slightly underinvesting in your business. And it would be fair to say that any major company in its history had some of this probably built in. We certainly have had our fair share. So one of the key things, and the most important thing is that we bring back this notion of growing the businesses that we're in. And that's obviously a healthy balance between volume and price growth. That might change from year to year or 6 months to 6 months, depending on how the global economy goes. But basically, in essence, we as a company are set out to grow consistently above the market. If a market is now about 2%, or the 2 to 3% range, but more likely closer to 2 than 3%, we need to be able to deliver 3 to 5% growth. When the economies are a little bit better and you have more wind from behind, which we started out in 2009 to 2011, more or less, that was a 4 to 6% range. I don't think, despite all the things you read in the papers, left, right, and center, that there is any reason to doubt, despite the challenges that we have, that we can perform in the 3 to 5% range. And if you've seen the company, we obviously made the first decision, probably the most important decision, that we're going to grow all of our businesses. You said we cannot do that and at the same time deliver on our profit commitments. Some of you said our brands don't have all the brand strengths. Others were saying, you know, you cannot withstand some of these enormous competitive pressures that we have had to endure in some of our categories. But at the end of the day, if you look at it in terms of the performance, if you look at it in terms of shares by category, I think we have broadly delivered on what we set out and then some more. 6 of our 10 brands are the fastest growing brands in Kantar, as Graham undoubtedly shared with you. On the top 20 of the top 50 brands, 24% are actually our brands, growing penetration faster than our competitive brands. And I was very pleased to see Andrew Wood's report on market shares. I know there are many different ways to measure market shares, and sometimes it captures it better than in other cases. Difficult to capture out of home. Coverage in emerging markets is not always as good as we need it to be. But if you broadly look at the trends in market share, you've seen some big shifts over the years. In fact, I was just looking at it coming in. But if you look at our hair care business, going from a 16 share to nearly a 22 share, those are big changes. Even our deodorants business going from a high 20 share to a 35 share over the last 8 years, those are big changes. If you look at male grooming as a total, we've nearly doubled that business. Our fabric softener business from a 12 share to a 16 share in markets itself that have been growing. So these are good performances, and I could go on, but for the interest of time, I don't want to do that. So we've been gaining share since 2009 by any measure, and I don't think we want to change that. In 19 of our 21 categories in HPC, if I take home care and personal care as one block for the convenience of time, are actually growing share. And that's a very strong and firm foundation that we want to be in. Amanda undoubtedly has explained to you as well that our food share loss has been decreasing since 2009, but decreasing alone is not enough. And since the last year or two, we actually see increases in share. Certainly if you take BCS out, which I will come back to later, we've seen increases in share in our food category as well, and we're happy about that. The second thing we had to do once we felt confident that the growth is coming back, and for simplicity, I don't go into all of these drivers for growth, but one of the most important drivers is our people and the confidence that we can win. The second thing we had to do was to build our margins again. We were sitting on a negative margin mix, and if you want to have growth that is honest, which we've always said we wanted to achieve, means that you want to grow top and bottom line at the same time. We call that the profitable, competitive, and consistent growth of our strategies. And it's not so easy. We've talked that many times, and some of our competitors have even coined the phrase of being their models. But there are very few companies that are able over a 10-year period of time to grow consistently top and bottom line. In fact, when I did the last survey of that, of all the publicly traded companies, in my previous role, which was CFO, it was about 8% of the publicly traded companies. But yet, in this time of uncertainty and volatility, I think that the market increasingly will appreciate and put a premium of that consistency. But I can also tell you, it is much easier and better to run a company with that consistency. You don't have to have the flavor of the week or the restructuring program of the month. You can really embed the changes much better if you are able to deliver that. Our gross margins now, as we've told you, are again accretive to the company. Where we see the growth, it is broadly accretive to the company. And that makes it much easier also to do our margin delivery that we promised to you. And in fact, doing it in such a way that we don't have to ask the consumer to pay for it. Longer term, putting the pressure on the consumers to deliver the value that shareholders are seeking is not a winning strategy. I hope you agree that with me, and there are many examples of that. Our gross margin is up about 170 basis points over the last 3 years. And yes, we could always have done more, but so could we also have done less. It is a carefully managed 170 basis points where we continue to invest in the business to guarantee that we have the growth in easier times and in more difficult times. 75% of our innovations, and you've seen some examples of that already today, and in the past, 75% of our innovations are now margin accretive. We were far from that not long ago. And then the third stage, next to this consistent growth that we wanted, the margin accretion that we wanted, and the positive mix, the third stage really was the establishment of the 4 categories. Absolutely crucial, because I think this was the moment in Unilever again that we really said loud and clearly, it's the categories and it's the innovation that is driving our business long term. It cannot be the countries itself, which were our center of gravity. But any of our long-term commitments on growth have to come from the strengths of our categories and our innovations. And you cannot run a company of our size and complexity with one general strategy. There are some things that we do as a company not surprisingly. But there are many things that we need to do in each of the individual categories. So having established the 4 categories only 3 years ago gave us an incredible opportunity to increasingly sharpen the strategies that were needed in each of these categories. And yes, we might be a little bit impatient, and we think that as soon as you switch the light on, that the results are going to come, but the payouts will accumulate and start to become more apparent in 2 or 3 years' time, and that's exactly the moment that we are now. All of our categories undoubtedly have strategies that can be further sharpened, and there will be learnings in the future. But all of our categories now have distinguished strategies. But they've also supported that by bringing in the right capabilities needed, and even the right people, I would argue, and to some extent their aspects of the culture to succeed long term. I don't want to bother you too much with that, but for example, the personal care category that Ellen is leading and has grown from 12 billion to about 20 billion euros over this period of time, probably one of the fastest changes in the industry. And that being done with modest acquisitions, not just turning the world upside down to find your answer. A lot of that in organic growth, as I showed you in the shares, is now clearly able to increase its growth rate amongst the part of the market that we really are concerned about, which is the premium market. Our M&A activities have helped there, but all of our initiatives now are actually focused on that. In fact, the growth on the premium side is, which we define as an index of 20 or 25% more than the average, is actually growing consistently 8% or more in that category. On foods, we're growing again. If you take the BCS out, I know that is not totally fair. If you take the BCS out, it's a 4% growth. If you leave the BCS in, it's a 2% growth. And in a market of food that is incredibly fast changing, faster than I have seen in my modest 35 years in the industry, it's actually a good performance. On top of that, if you're able to strengthen the financial contributions of that category as well. Home care, I've said many times, was mismanaged by Nitin's predecessor, which happened to be myself. And Nitin has come to senses and said, we also need to make money. You can't only grow the business. So Nitin, with enormous passion, his 5S program and other things, is rapidly bringing the profitability back to competitive levels. And yes, you guys want to know where it is to fill your spreadsheets and how fast we will get there. But if there is one person that is going to deliver and is actually in the process of delivering on that, it is Nitin. And then the last category, obviously, is refreshments. Here, we really need to look at this category much more from a cash flow, on a return on invested capital point of view. And interestingly, if the company is about 19% from memory, this category itself, you take ice cream, is already 15, 16%, and has seen its improvements of 300 to 400 basis points over this period of time. And I don't think we have seen the end of it. So the clarity of the strategies of each of these categories has been fundamental in making this a stronger company. And then, as we did these basics of these 3 steps, we also continue to work the portfolio. I know some of you like to write or suggest that there are bigger acquisitions out there, and you have far more insights and foresights on how to do that clearly than we do. We actually see that our strategy of consistently growing our brands and doing carefully but thought through acquisitions has really given us a significant change in our portfolio at an attractive return on investment, if you want to, for our shareholders as well. It's interesting, if you look at the selling of our assets, which frankly were not that strategic for us anymore, and the multiples we got on that, it's about 1.9 times, versus what we paid for what we acquired, from memory, was about 2.1 times. I cannot think of a better ratio. And most of our investments, if not all of them, I can think of 1 or 2 smaller ones that were learning opportunities, but most of these investments we've done have been strategic and strengthened our presence in the categories, gave us competitive advantages in some areas, but more importantly, have been enormous payouts for the organization. And at the same time, provided us with some new growth opportunities for the future. 4 billion spent on acquiring, 3 billion of divestitures. another 3 to 4 billion on buying minority shares, which, by the way, is one of the most strategic acquisitions we can make, and even those have been very beneficial for the company, I believe. In transforming our portfolio, we have created a prestige leg that has opportunities. And in this case, in my opinion, in prestige, small is beautiful. And the unit of 400 million plus has already a critical size, but certainly a lot of upside. We've created the air and water purification leg, about of the same size. I cannot think of nobler ideas and a bigger need out there for any market on air purification and water purification. The latest report that came out from the World Health Organization, Margaret Cheng, pointed out that about 80% of the world population is living in places where the air quality is outside of the standards of the WHO. And if the 80 is a magical number or not, but in China, 80% of the groundwater actually is already contaminated, if we like it or not. That's unfortunately the economic system that we have created to try to get growth. So these systems that we are putting in place are tremendously important for us and have certainly the opportunities to grow to $1 billion plus in business itself. Then, with the Dollar Shave Club, you've seen that, I think, another wonderful acquisition. The future needs to tell, but we're getting into different channels and trying to understand the direct-to-consumer channel, which we think we can leverage tremendously across many of our businesses as well. And seventh generation actually got us back in the US into home care, if you want to, in a very modest way, but in a category that is very relevant. And none of these acquisitions actually have disappointed us since we acquired them. So they certainly have maintained or accelerated their growth rate. And the last one I want to call out, I could go on and on, is Unilever International, rapidly becoming a unit that is approaching $500 million this year, and no reason why it cannot be $1 billion in just a few years' time. Basically playing on to the fact that we have, despite what you read in the papers, a much more movement of people across the world than at any time in history. And as a result, there are niches or pockets of growth, big and interesting enough to cater to all across the world, be it the Muslim population in the US or the Turkish population in Germany, and the list goes on. So we've created this strengthened core with our main strategy, and we've prepared us for the future with our M&A at the same time as we transformed our portfolio. And this puts us in a reasonably good position to optimize what we call our mothership, which is the main aircraft carrier, if I may simplify it, which we should be able to grow consistently at the 3 to 4% range, putting better paint on it to make it go faster, being a little bit more efficient with the crew to spend less money, putting a little bit different gasoline in there to get more mileage out of this. And this is what we do for a living. It's called core of the core, nothing else. Not more complicated than that, but hard work, day in, day out. This is where perfect stores fit in, and many of the other things you've become familiar with. And then we've created the optionality around that with the speedboats. Units that we keep independent to some extent, where we add our value where it makes sense, where we leave a strong ownership, often of the founder of the business, and where we take learnings and surely, slowly but surely, if you want to, impermeate these learnings into the Unilever model. Now, spreads, I could say a few words about spreads now, which I also think that putting it in as a separate business unit has actually been the right decision. It's been actually a very safe decision, because by doing so, we were able to take costs out that we were probably incurring, but not needed. By making this business independent, we exposed that. We've been able to push these margins above 20%. And from a cash flow point of view, or from a contribution point of view, it continues to be an attractive business for us. But at the same time, we need to continue to look at opportunities if the business continues to go down. The core of the organization who works on this will continue to focus on trying to grow the business. That's what they get paid for. And increasingly, we see pockets again where we see the business responding. especially around some of the plant-based initiatives. But at the same time, we will continue to look, as this business becomes smaller by definition, we will continue to look at other options. But I want to say once more, and hopefully for the last time in front of all of you, these options need to make sense for the shareholders. They cannot just be options of, let's get rid of something that we don't like. That's not how we run our company. That's not how we built this company into what it is today. And that is not what you should be doing in any other company either. You'd be grossly irresponsible as agents for your owners to even demand that. So a little bit of a sophisticated approach of thinking about this is absolutely important. If the moment comes where we think that value can be better created outside, we owe it to anybody to pursue that option. But we simply haven't found that yet. And at the same time, most, if not all of our people working in this wonderful unit are continuing to address some of the structural issues that we have to deal with. At the same time as we've made these changes to our fundamental operating model, as well as our way of doing business in terms of changing our portfolio, etc., it's also important that we talk about the basic philosophy of how we do business. And that is obviously well captured in our Unilever Sustainable Living Plan. You've seen some of that today. But again, increasingly, if you open the newspapers on a daily basis, I hope it is increasingly relevant to most, if not all of you, that running your business in a responsible way for multiple stakeholders is increasingly more important. Otherwise, you'll get a lot more results like you've seen here in the UK with Brexit or the recent results of the US elections. We have to find a system that guarantees the future of mankind, that takes future generations into account, that doesn't create a further burden on the world, but provides solutions to solve some of these problems, and makes it a more inclusive growth model. When we started out with the USLP, undoubtedly it raised some hairs because you wanted to understand what it meant. But increasingly, I was very pleased to see that 80% actually of you think that it's already a positive driver for the business. And that is not surprising that there is more data out there that ESG investing increasingly is linked also to higher returns. The movements of divestiture of portfolios of carbon or calling for prices of carbon, since we have the COP21 agreement in Paris, is just an example of that. So we continue to see the USLP as an enormous stress on us, if you want to keep performing. Because if we don't perform, people will be skeptical about the way we do business. So don't underestimate the performance part that the USLP gives us. It's probably one of the best performance measures you can put into a company that is high purpose-driven than any other measure you can think of. But think also of the corporate risks increasingly. Think about the costs that we're taking out of our business. In our case, over 600 million directly related to that. Think about the opportunities it creates. Some of them I just shared with you. So from all senses, if we continue to manage this over multiple years, not try to boil the water in 2 minutes, it is a very, very good thing. And one of the reasons that you see a stronger organization is because we're able to attract the talent. We don't have that issue with 1.8 million people applying to us every year. We don't have that issue with being the preferred employer now in most of the countries where we operate and where we measure it. We don't have that issue with a company engagement score up in 91% during very, very difficult external environments. Many companies would envy to have that. If there is something that I would be worried about is, do we have the right organization to deal with the challenges sometimes that you can foresee or the challenges that you cannot predict? And the answer always should be that your best investment is your investment in the right people. And we are very blessed with that. And I think that's one of the main outcomes of obviously what we're trying to do with this purpose-driven business model, which we call the Unilever Sustainable Living Plan. Now, the reality is that the world is changing faster sometimes than we are changing. I've never seen changes happening so fast in the industry. Some of you foresaw it and warned us for that. Others are still trying to come to grips with that. But the thing is clear that in the past, if you missed a trend, or if you were a little bit slower than you could have been, you more or less could get by with that. You would catch up and business would go on again. It is very clear that in today's environment, if you miss a trend or if you are too slow, you are getting punished disproportionately. The price of missing trends, the price of lack of agility is only going to go up. So the companies that will survive in the future are the companies that on the one hand are more agile, but on the other hand also have built up a certain resilience to deal with this volatility that is out there. And frankly, many companies struggle with that, not only the big companies, also many of the smaller or local companies. Now we think that even with our results and all the steps that we've taken, I've taken you through, that we are not yet at the top of our curve of performance. We're sort of seeing this top. Most of the companies make changes when they are on the downslope because they panic and they look down and it doesn't look pretty. Some have the foresight to change their organizational models when they're at the top because they can look down and certainly want to avoid the slide which is difficult to recuperate from. I think we're at this point in our company still that we're just below that top of that bell curve. And we're trying to anticipate what is going to happen in society to jump to the next bell curve before we see more pressure building in our business. It's not easy because some people say it's going well and results are fairly reasonable. And why do we need to have all these changes still? But the reality is, if you look at the global level, we are growing share. I just explained that to you. Most of our global competitors are actually not growing share. And if you see who is then winning in this market, you see it's the local competitors. It's actually not because they have scale or low cost or because they have technologies that we don't have. I think our scale advantages would actually work towards us. It is that they are closer to the consumers in these markets, that they're able to pick up trends quicker. We might have to wait for these trends to appear in multiple markets, to call them global trends and create a movement in the company to respond to that. It is perhaps because they have a little bit of a different risk profile in the countries that they operate. For all these reasons, we need to be sure that the next step of change in this company addresses this issue of agility and winning in each of the local markets. Now we believe by coincidence, certainly not by design, so it's not something we want to take credit for, but we believe that we actually do have a competitive advantage in responding to this. Not least our long presence in these emerging markets. Not least our people with that experience. But above all, we came from a model not long ago that was very decentralized. We have a mix in our company of about what I would call 70-30 to keep it simple. 70% of our global brands, like the Doves or the Lifebuoys or the Omos, which are doing increasingly well, but also still 30% of the local brands, which have always necessitated, but also allowed us to stay a little bit closer to the local consumers and to be a little bit closer to these local insights and understanding the pressures that are needed there. What we now need to do is to look at the successes that we have in different parts of the organization, where we have been close to these trends, where we have been fast, where we have shown the benefits of this agility, and see if we can institutionalize that across the total company. And for convenience, we call that Connected for Growth. Now, Connected for Growth is not a new marketing plan, as some people have called it in their write-ups. Connected for Growth really is a different operational model that affects everybody in the organization. This makes it challenging, and this makes it one of the biggest change efforts that this company has ever done. Sure, we've done the Fit to Win, so we've done the Project Halves. We've shared with you some of the other initiatives over the years. But for the first time, this change encompasses everything we do. It sharpens and changes our strategy. It changes our structure. It changes the processes. It changes the role of our people. We even, as I will mention later, plan to change our compensation systems behind that. It fundamentally changes the way we do business. What are some of the main elements that we want to get out of it? Be closer to the market. Be faster with our initiatives. And drive again more the ownership mentality, where we have clearer lines of accountability and responsibility with fewer people. An organization that is leaner even on the support and staff functions, if you want to, and more focused on the frontline functions. An organization that is joined at the hip at all levels. No handovers. So what we have designed is a system that you might have picked up some of the words around that, which is the CCBTs, the country category business teams, will actually be the center of gravity of our business. There are about 250 of those. And these teams, you should see them as mini entrepreneurs, as mini owners of the business. Full responsibility and accountability of delivering the results, including the financial parts of it. The leader would be a mini general manager, ideally placed to develop themselves to the future leaders in this company, the future CEOs of the subsidiaries, presidents of categories, or the future CEOs that we need as well. These CCBTs report into the categories. The reason we do that is to give the categories the connection with the markets and the ownership of delivering in these markets without any handoffs. Faster feedback on the insights that are needed to respond to, faster feedback and faster delivery of the results that we need in the marketplace. Where we've implemented this already, where we see this functioning, we see significant differences in the results already. We're very positive that this is the right thing to do. At the same time, the markets itself have a tremendous job. If you are the general manager in a market, you need to have your go-to-market strategy, which depends on your portfolio. It depends on the development you're in on the market. It depends on some of the external constraints that the market has. Not every market deals with the same competitors or regulatory environments and everything else. So there's a huge job to be done to develop these country strategies, to enable these markets to grow, to build the capacity, and that will all obviously happen in the markets itself. Increasingly, to be able to go fast, we also reallocate, as you probably have heard, some of the R&D or manufacturing resources back to the markets. We're looking a little bit more flexibly at looking third-party resources for production as well, something we've seen work very well for some of the brands that we have acquired. And as I was mentioning before, 70% of our portfolio being global and 30% of our portfolio being local, we will also again put more of that local work of the 30% back into the countries. We simply became a little bit too centralized and in some cases too far removed from the consumers that we wanted to serve. I'm very excited about this new organizational model because at the same time as we make these structural changes with the objectives that we have, we've also launched some of the projects to support and institutionalize this. It took us about 18 months to think about this. We could have gone earlier, but we wouldn't have done such a good job in implementing this. ZBB is an integral part of this. As Graham has explained to you, it's not so simple as zero-based budgeting that some of our other competitors out there make it believe, which has been roughly translated into let's cut all the costs as long as we can get away with it to show you better margins for a short period of time. But I can't promise you any growth along the way. Our ZBB is really looking at re-engineering all of our processes. Re-engineering all of our processes exactly to make our company more market-focused, more ownership accountability, and to be faster. So we've looked at the S&OP processes, the brand planning processes, and many of the other ones to take the waste out, but to also reinvest where it counts, to be able to grow faster and to be more front-facing. We do the same with net revenue management, and we do the same with Digital 2.0. Digital 2.0, very, very important because the way that the technologies and other things are emerging now requires us much more to be faster in our communication as well and to be more localized to some extent in our communication around global or regional strategies for sure. But if you now can have your individual messages received, if you now have to be 24 hours engaged with consumers, you can understand that that cannot be done from a headquarter or an ivory tower. We have to bring these capabilities back to the country levels, and Digital 2.0 is bringing these skills there. A tremendous training effort is going on under the leadership of Kees Wiet that touches everybody in the organization. So I hope I give you a little bit of a flavor of the holistic nature of the change program that we're going through. I would say at the end of this year, we should be about halfway through this. And my goal obviously will be that by the summer of next year, ideally, give ourselves a few months flexibility, but we should have implemented this, and we can fully focus then on getting the leverage from it. When Graham says we can continue to grow 3 to 5% on the top line, is because we are creating more flexibility in the organization itself, including the financial flexibilities, to be able to deal with what we anticipate to be an even tougher environment. When Graham says the range of 20 to 40 basis points operating margin can be moved to 40 to 80 points operating margin, is because we are confident on the way we run the business and the savings that we can get out of these efficiencies that we've delivered, especially around ZBB, which now are indications to us that that could be well over the 1 billion euros in itself. It gives us the indications that we can really go to that next level of delivery. That next level of delivery that would be at the same time delivered, obviously, with a better management still of our working capital. You've given us a lot of credit for that, but we've always said to you, we don't think we deserve it, because we see a lot of opportunity still to bring our inventories down. And frankly, if I'm slightly frustrated, is with the speed that we are doing this. And Mark now is really on to this, so we think we can improve our working capital. We also are very mindful that you let us spend capital to reindustrialize our base, especially in the US and in some other places. If I were you, I'd be the first one to ask for a return on those investments. Those were big investments. Just on capital alone, my estimate would be that we've invested at least 5 billion more versus a trajectory that we had. But now we need to go back to the 3%, 3.5% level maximum on the capital spend. The combination of our increased core operating margin, which you know, by the way, in Unilever is everything included, our working capital discipline, our lower capital spend, should see an improvement in the overall financials of the company, and I also think the overall return to our shareholders. We have to be a little mindful for this year and next year in full transparency, because in this company, we don't trick you on the numbers anymore, like we see some others out there continuing to do. If we have restructuring, we deal with that. Right now, we're in a major part of our restructuring. We're cutting 10, 15% of the organization, reinvesting some of that in front-facing and sales. But these are major changes that need to be financed. And we're trying to do this, changing the engine, basically, whilst we keep this car running. So in the beginning, we might be more on the bottom of this new range, and over time, we will move to the middle and hopefully one time to the top. My final points that I would expect to come out of this is an organization that is even more innovative. An organization, which is the third column. I'm clearly not sticking to the slides here. An organization that actually looks at all its innovations and which have become significantly better, as I've shared with you. But we've set our objective, which I personally think is within reach, to cut that time in half again, and to be able to double the speed with which we roll out things across the world. I can give you many examples that we can celebrate that we have done well, but I can also stand here an hour and share with you things that probably won't stand the test or pass the test 4 or 5 years from now if we would continue to do the same thing. So we have to become at least half in time bringing it to market and double the speed of rolling it out. An organization that has significantly lower cost. I think once we get into the mode of ZBB, we will also be able to continuously generate the savings. World-class manufacturing is a good example of that. We visited some of the companies that have applied it, and Mark Engel and I spent some days in different companies looking at it. And what you see is that once you get that mentality and culture in an organization, people start to see more opportunities, not less opportunities. Simplified processes is absolutely key. If we don't have the simplified processes, it would simply boil down to asking more people to run faster and faster with the same tools to get better and better results. If you want a recipe for burnout, there you have it. So if we don't change the processes, if we don't let go of things that don't add value, we would not come there. This is absolutely a crucial part. And then last but not least, I don't have to tell you that, it's all about people, as I mentioned before, and continuing to get the engagement of the people. We derive some pleasure out of the 91% engagement score. It's higher than I would expect with the pressures that our people have to deal with. But our people say continuously as well, we're too slow. We're spending too much time still increasingly on things that don't add value. I have to learn to be not only multitasking, but triple tasking. If in every meeting I go to, I also don't do emails, call my wife, and take care of my children, I cannot have a decent life anymore. So we have to free up that capacity of our people to be able to implement this agenda. And this is where the energy comes from, because everybody sees that we're taking out the non-value added, the transactional cost, the discussions that probably were not needed, the lack of clarity on who has a decision right, the speed which we can now connect people in terms of reporting. And all of that will be underpinned by an employee system or an HR system, which is much simpler. We're getting rid of some of these artificial layers that we have in our company. We're freeing up our performance measurement system in a radical way that continues to set the high standards of performance, but takes a lot of the administrative tasks out. We've significantly changed our recruiting system, for example. We can hire people now within a week in a process that is better than what sometimes would have taken us 3 or 6 months. We're also looking at the way we compensate people. A little bit more long-term even than we've currently done. A little bit more skin in the game. An opportunity over time to get more of our shares of this company to share in its success. People will undoubtedly be better off if the company does better, but if the company doesn't do better, they'll actually be worse off than they are under our current compensation plan. And guess what? Our people believe so much in what we're doing and the plans that we put in place that they're actually looking forward to this and being part of being even more of an owner of this company and be part not only of driving this success as a result, but also sharing in that success. Our long-term targets will not surprise you. They will be underlying sales growth. We will continue to look at that on a cumulative basis. Very important. We will look at core EPS. Many of you have said it would be good to have an EPS target, which I think we will share with you the ranges and deliver on. A Unilever Sustainable Living Plan target. Believe it or not, many of our shareholders are saying, you know, you're doing all these things, but what are some of these targets you want to achieve? And can you set the bar higher? That's important, how important it is to us. And can we also make it part of your compensation? And then we're looking at return on invested capital. And based on a lot of the feedback that you've given, Andy has been useful with Cedar Rock and many others to say it's important that you do return on invested capital, but then do it only for the people that can make a difference. Don't make it a confusing measure for someone down in the organization that really, frankly, cannot influence all the key elements of it. So that is probably something that we would give to our ULE members that can make these decisions and be responsible for that. So I believe that in this short little resume, you've got a good overview of the changes we've made, the changes we are currently in the process of making, and the results that we expect coming out of that. I think that you've seen a different Unilever, perhaps over the last few years, but we will stand here hopefully a few years from now and say, boy, I didn't know that we could survive in the way we were doing business currently. And preparing ourselves, at least in my vision, for the next 5, 6, 7 years of an environment that is not going to be easy, but that we certainly want to continue to be a top-performing organization, not only on the bottom line, but also increasingly paying out the investments you let us make over the last few years in the bottom line. It will be an organization that will be top performing. It will be an organization that will be fun to work in. And the only number I worry about is how do I increase an engagement score of 91%. So if you have any ideas, share them with me. So with that, let me stop the my side of the conversation and open it up to anything you want to talk. Andrew, are you leading it?
Yes. Jonathan, yeah.
Who wants to kick it off?
Yeah, we have Jonathan here. Yeah.
Thank you. Paul, your comments about the spreads of the BCS business as a whole, especially after having had the enjoyable privilege of going through this factory number 4 here and literally seeing this outstanding business, and just you can see the dollars running in the door, 87 full-time employees. I look at your foods business globally as a lot more like the spreads business than it's like that business. And so I guess, what role do you see the foods business broadly playing? How integrated is it in the supply chain, of your other, of your other businesses, and what's so different between your foods business more broadly and the spreads business that you think very tactically about the spreads, but not so much about foods? Thank you.
Well, spreads, we think about it not only tactically, that would be unfair to the spreads people, we also think about it strategically, but it's now a 4% issue that we need to solve, and we will be solving that, but I don't think we have to have too much conversation about it anymore. The food business, I think I can only talk a little bit about how I see my last 8-9 years in the company, if I may. But the food business in this company has been under a lot of pressure for a long time. When I came into the company, the share decline on that business was significantly higher. In fact, we were losing, if you look at Andrew Woods, we were losing about 0.9% share every year on this business. And in the last 3 or 4 years, that has gone down to 0.3%, which is this improvement I talked about. When we did Best Foods, for all its good and its bad, you can have, in hindsight, again, we can all have opinions about that, but it basically gave us more in Europe and the US and less in performance. When I came into this company, that business was 75% Europe and the US and 25% emerging markets. So with Antoine and now with Amanda, obviously, doing an outstanding job, we have now moved this business, don't quote me on the exact number, but I think it's either 43 or 45% of that business is now in the emerging markets. I actually was looking forward to about 50%, but because of all the currencies and other things, we probably aren't there, but we're growing 7, 8%, 9% in many of these emerging markets. So we had to change the footprint. That is one thing that we've worked on. And one of the reasons you see the growth now being 4% is because of that footprint change. No question about that. The second thing we had to do was that portfolio was not very focused. It still was a little bit all over the map. And now we have a business of decent size, as you have seen. It's still, our second business unit. And it really has a very focused spreads, if you want to. It has a very focused dressings business. It has a very focused savory business. And then if you want to, tea and ice cream, if you want to add that to it. But there is no business in the world that has so much turnover in only 5 categories. And we really got disciplined every year in divesting a lot of our other food businesses. So now it's a very focused business that is number 1 in each of these categories with twice the share of our competitors, with the exception of savory, where we are increasing the share gap, but we don't yet have the twice. What is happening in this category is that obviously there's an enormous change at an enormous speed in the way people eat. I don't know if Amanda talked about the flexitarians or the people that look at sustainable and bio and green. I just came from the US, I flew in this morning. I never thought the US market would change, The bigger the hamburger, the more on your plate, the more calories, the lower the price, the happier they seem to be. But that country has changed quite dramatically at a speed that nobody anticipated. It put a lot of companies in a challenging position. Many of the food companies, many of the fast food chains, etc. Within that scenario, and our size of the business growing 4% is pretty good. And one of the reasons that we can respond, never fast enough, we will not say that, but one of the reasons we can respond is actually because of our Unilever Sustainable Living Plan. We've put up a lot of our value chains and made them sustainable. We've worked with our farmers on landmark farms, on livelihood programs, on women, exactly all the things that are becoming increasingly important for the people who care about food. So I think with Amanda and her strategy, and increasingly the bio-based, plant-based strategy, with her strategy, she is very well placed to continue to grow this category. And it fits very well into our overall strategy that we keep saying. For example, in Africa, where our business is now starting to be unlocked, most of our regions have grown share. Africa, I would say our share has been more or less flat. But now we're starting to unlock that with the investments we've made in people and infrastructure and in our portfolio. And the main carrier of that is our food business. And that food business brings us very close to the consumers, helps us bring this USLP alive, so it plays a very important role. So I think we're in a good position now for Amanda to deliver at consistently high margins, by the way. So it's a very strategic part of our model.
Yeah, next question. Yes, Eileen.
Hi, Paul. You got into a new category, the purification business. As you look at your portfolio now, do you see further opportunities to enter new areas that you're not in already? And maybe more generally speaking, what are your priorities now for M&A? Where do you still see gaps, and would that mainly be in HPC or perhaps other areas too?
No, I think so one of the other things that has happened, for example, the healthier or the more natural, which we also see coming in other categories, just what we talked on food is what we see in other categories coming in as well. There is space in that area where we are still not where we need to be. On the premium side, whilst the world is more bifurcated and we have a lot of pressure on a group of consumers that don't see their economic situations improve, there is also a premium side that we continue to focus on. So you take tea. We're not managing our tea business badly, but we have the bulk of our business, unfortunately, in a segment that is rapidly becoming smaller because people are moving to premium tea. So getting faster a bigger presence in premium tea is important. In ice cream, which we prioritized, we have done that. And you see the benefits of our ice cream strategy now, which is really working for us. A brand like Magnum, when I joined, was 600 million. I think now, I don't know where we end up this year, so again, don't quote me exactly, but probably between 1.2, 1.3 billion. That's just in a very short period of time. So I see the natural segment opportunities. I see opportunities in the premium segment of our categories. And then in some of the extensions that we have done, which I shared with you, we need to make that work and grow into critical mass. There is no need to say, let's open another factor or another category that you're not in. I think we want to cement this and grow this and perhaps look at strategic bolt-on acquisitions that strengthen our current strategy. And we have enough opportunity there. Opportunity to make it global, opportunities to extend it broader. You take Dollar Shave Club. We see many opportunities that we can extend into male grooming with what we've had. So it's more leveraging now what we bought. T2 in tea, it's a great business. We have doubled that. Our premium tea is now getting to a size that is starting to be competitive, in my opinion. But we still have a limited e-commerce business. So we want to extend that and strengthen it. So those are the areas that we will, above all, be looking at.
Yeah. Stuart, yeah.
So, Paul, I think I've been coming to these events for over a decade, and it's the first time that in no presentation has volume growth actually been referenced or mentioned. So is there some message in there?
No, not at all. And I did mention it. It's just that I was very light on my slides and didn't, in due respect to Fidel Castro, I didn't want to make this a 5-hour talk. I thought I limited to half an hour, so I didn't cover everything. But what I said was our growth rates moving forward, if you've picked it up, would be about half volume, half price. Internally, we certainly will look at volumes And we have internal measures that we still think it's very important to be sure that people understand the volumes. It's the volume that now might not be every quarter. We had a quarter of no volume last quarter. It might not be every quarter. There's very limited volume growth right now globally if you go around the world. But the best way to drive efficiencies in the company is to get more products into your truck and to get more products off your line and to have the same consumer using more of your products. So let's not kid ourselves. The volume component for us will always be a very important part of it.
Yeah.
And should stay so. I think what you actually will see on a global level, you'll see the pricing component perhaps going down a little bit as we move forward. And you'll see our volume component picking up a little bit. If I just look out in the next 1 or 2 years, which are better to forecast than perhaps beyond that. But to go straight to your question, volume continues to be a very important indicator in this company. And I'm actually glad that we introduced that again when I came in and that we continue to measure that. There's not one board meeting that we have, and I mean, Alan is here and Graham is here, that we don't look at that. And not one country visit that we don't look at that.
Yeah. And when Graham talked about managing through volatility, I remember he talked about the focus on both volume share and value share in one of that part. So let's take another question.
No, it's key.
James.
It's a bit of a personal one, Paul. How much longer do you see yourself as being CEO of Unilever, and what sort of quality should we be looking for in a possible successor?
Well, we have Marijn here, so Marijn is joining us, and obviously you've all met Marijn already. He will talk tonight. So he's the key decision maker and my boss. If he decides I need to go tomorrow, this might be my last talk to you guys. So we will see. It's obviously at the discretion of the board. But I very much have said to Marijn, and obviously Marijn coming in, we've spent a lot of time together, and Marijn is very actively involved. Every week we have things together, and as Marijn learns very quickly the business. When I made the commitment to come to this company, I had some clear ideas of what this company could be. I certainly don't want to overstay, but I want to be sure that when my time comes to move on, that I don't pass on a problem to my successor, because the time is tough enough. The issues we deal with is tough enough. So as a minimum, we're in the midst of this organizational change that we really need to cement and see it work. Obviously, I've presented to you all the things that I envision it could be. But it would be naive to think that we don't have some bumps on the road to this implementation, because we've never done this either. And it's quite a complex and to some extent scary thing that we are doing. We're very enthusiastic and energetic about it, very motivated to do this very well. But it would be irresponsible to run away from that. And the reason we do this, obviously, is to get the company in the right shape before it is too late. I would certainly want to see this through and be sure that we get the results. And then at the same time, with Marijn and the board, we've spent an enormous amount of time on thinking about our structure, our people, and how we grow talent. And from a situation that might have not been as deep as we wanted to, we are now very blessed. Deliberately in these type of events, I only show up sort of at the end, and I find an excuse. This time I was in the US with Case, and I only flew in now to be with you. But I actually do that deliberately so that you can see our people. They can hold this meeting by themselves. Any of the people that presented can run a company of billions by themselves. They are top managers by any benchmark or any standard. And that certainly would be if judged by the offers that they get from any other industry. And they have big challenges in each of their categories where they can now grow and develop themselves. And there is no doubt that when the moment comes that the board needs to decide that we have internal candidates that need to be benchmarked undoubtedly against external candidates, but they will all be of fine quality. I have no doubt about that. And you have been exposed to many of those, so you can form your own opinions. But looking at what some of you have passed back as feedback to me, or what some of you are writing about, I think you broadly agree with that. And the most important thing for myself, for Marijn, is indeed to be sure that we not only have the right governance in this company and the right strategies, which we hopefully do, but that we also are 100% focused on the succession, not only of the CEO, but also on the broader implications for the company as we move into the next business model. So these are ongoing discussions, and but I certainly don't want to overstay. That's the worst thing you can do. But you don't want to run away from mid-flight either. I was flying back with United to Manchester. It's the only direct flight from Newark to Manchester, and it's only a 5-hour flight, so you can't sleep. But I was looking at the door just to be sure that the captain doesn't jump out halfway. That would be very sad. So in that situation, we have some responsibility we sign up for. And that's what we have to finish. So we'll take one or two more?
Yeah, two more, or one or two more. Celine.
Thank you. I would like to understand how connected for growth change or not the ability to win versus the market. I think over time you have said that you could outgrow your market. I think 1% has been a number that I have in mind. Does that change with connected for growth? Could you accelerate, or basically it's just the price to pay to keep that? And then how you had balanced this ability to grow versus the decision to deliver more on the margin?
Yeah. No, I think you don't want to pull one of these elements out and say, what does this give and what does that give? There's net revenue management, and that helps you on the top line by being sharper and more differentiated by channel and having your sizing, pricing strategies more embedded in the categories. There is ZBB that obviously generates a lot of funds, but also simplifies processes. And there's connected for growth, where its biggest change will come from being closer to the market, changing the culture. A culture that is faster, more ownership, entrepreneurial, founders mentality, as we call it. So I'm not going to pick those apart and put numbers on them. But undoubtedly, what I see is that that in order to deliver results in the future that you expect, we're actually doubling the profit output, what we're telling you, if you haven't picked up on that. We are maintaining the 3 to 5% growth rate in an environment that I think is going to get tougher. So we are cautiously responsible by saying that we need to generate internally the capabilities to deliver that. It's going to require more effort, more spending in some cases in the future to get the same results. But we are able to generate those spendings and some more to deliver not only the top line and the bottom line. But I envision, and we might be wrong. In case we are wrong, we have more wind from behind and the results will be better. But I envision, unfortunately, a tougher environment in the next few years ahead than some of you might expect. I've always been moderately, according to you, pessimistic, or I thought realistic. And unfortunately, the scenarios I've shared with you have always played out that way, at least from a market environment, or if not, a little bit worse. It's sad for the people out there who have nothing to do with it, but it's the reality. We are not living in an easy time. We have nationalism coming back. We have globalization going down. We have governments that are on shorter cycles, populist strategies that we know are not the right long-term things. We have a financial market that is still in much turmoil. And you can hang yourself on some good things and say, here is a good thing or is a bad thing. But the IMF or the OECD have continuously lowered their forecast on any forecast they have done. And I think we have to be very mindful of what is happening out there and be very cautious of how we respond to that. And that is what we are trying to do in our business. And I think the programs that we've shared with you reflect that. The other thing I want to thank you for, because on the way over I was reading your report where you did a good analysis, in my opinion, on the Indian effect and the demonetization, which are typically one of these things, again, you have to deal with. But I think you're spot on the way you are analyzing that. And I think you would have to make it compulsory reading for your colleagues here. But these are the type of things that I think you will now see on a quarterly basis. And that could really throw the monkey wrench in on the short term. In this case, India, we have only 4 weeks left of the year. And it's a big effect. When all of a sudden 285 billion is taken out of the economy, when the banks can't print anything, when people run out of money, and the government is scrambling to adjust their strategy, doing the right thing long term, like they do with their general sales tax, and getting rid of the black economy, whatever you would call it, the illegal economy, is very important to us, because those are all these local competitors who are competing with you, sometimes under different rules than we deal with. So we see this as a long-term good thing, but you have to go through these short-term issues. And I think we will continuously have short-term issues that we don't want to use as excuses on a quarterly basis, in my opinion. This one happens to be India, and I'll wait for the next one next quarter. And that's why we need to build up that resilience. Remember when we talked agility, I talked resilience at the same time. And part of that is this financial resilience and organizational resilience that Connected for Growth is giving us. I hope that answers your question, more or less.
Should I just one last question then, Paul?
One last question.
Last question.
Last question.
Yeah, Robin.
Yeah.
Yes, thank you. Obviously, these large consumer companies are facing lots of different challenges. Would you agree that one of the biggest challenges is from these local companies? They are becoming better, the products, the quality, and a lot of these big mega companies are talking about agility. So it seems to be addressing this issue of these local companies who are getting better, undermining the business models that have been in place for these big companies for quite a while.
Well, you can interpret it different ways, and I'll let you interpret it your own way, but it doesn't have to be. You have to, if, the assumption that scale is bad or makes you bureaucratic or makes you slow, etc., doesn't have to be. It could be if you want it to be. But you can think about it in a lot of ways as advantages. We have more financial power, we have many more places that we can learn, we can get better technologies in, we have people that have been in many of these countries for long times. And frankly, in each of the countries that we operate, we might be a big global company, but in each of the countries that we operate, we're a local company that sometimes is also small in the first place themselves. So if we can combine the best of what we want to have locally to win with the best of what we have to offer globally, we think that we can create still competitive advantages. There's absolutely, to me, no doubt. The bigger challenge, I think, is not the local competitors, because what you really see here is a phenomena of these emerging markets actually becoming more mature. It should be good news for you. If you would look now at the currencies, for example, how they have moved with the uncertainties that are in the world, where you see the Mexican peso go down 15% in 2 minutes, or Brazil, which is collapsing, whatever, or any other currency I could pick. You don't see global chaos anymore. You don't see an Asian crisis anymore. And the reason for that is because these countries have developed a reasonable level of middle class. These countries have developed a reasonable level of governance. There is a certain level of stability in the global economy on the positive side. And as a result of that, you also see local competitors starting to develop, just like happened in the UK when the UK moved to a more industrialized economy. That now happens in many of the countries around the world as well. I've always said that our biggest competitors in the future, we call them local, but they will be competitors from other parts of the world than the 4 or 5 that we always talk about. And actually you start to see that happen now, under your eyes. Retail is a good example of that, interestingly, because I don't know any country in the world where the major retailer is not a local guy. Here you have major retailers that are local. In US, the major retailer is local. In Italy, it's Co-op. In the Netherlands, it's Albert Heijn. And the list goes on. ICA in the northern countries. So you will see major industries emerging in the bigger countries that we compete in. But that doesn't mean for us that the pie is less. It actually means quite often that we should be able to grow faster, being market leaders, having more mature competitors developing these markets with us. I don't think it's a bad thing. Our market share might go down a little bit, but I'd rather have a 50 share of a 10 times bigger market than a 70 share of a 1/10 market. So we have to get used to that perhaps as we look at that. But this organizational change hopefully responds to some of the things that we feel could become handicaps in our organizational model a few years from now. The bigger challenge that I would think about is actually two other ones, which are more important. The one undoubtedly is talent in any part of the world. How do we continue to attract the best talent, especially in those parts of the world that we are well positioned in with our portfolio and where over the long term the bulk of the growth will be coming from by definition. And I think we're very well placed for that, but we have to be sure that we can continue to attract the right talent. And the other one I worried about is the legitimacy of the business, to have the permission to operate. Many businesses, also the ones you invest in, risk not having the legitimacy anymore to be part of this economic system. And we'd like to stay on the right side with that legitimacy. That is the essence of what we're trying to do once more with the Unilever Sustainable Living Plan. Most of our value is our reputation. It's not anymore your assets or anything else. It's your reputation. And that is changing quite rapidly nowadays for many companies. And increasingly, the consumers of this world will reward, hopefully, the ones that participate to make this a better world, and be far more punitive to the ones that don't carry their fair share or actually make the situation worse. We've started to see that happen in the energy sector. Divestiture movement is rapidly increasing. We're starting to see that happen in many other sectors. So the legitimacy in a world where people expect a different role of business ought to be the concern of many more companies. By outsourcing your supply chain, it is totally unacceptable in the future for any consumer that you defend that also as a reason to outsource your responsibility for your supply chain, for example. So we think that our model, for which you allow us to invest, these things don't come for free. Invest in people and energy, sometimes money, makes our model more robust. But I do worry about that. I do worry about it every day, because you can see how quickly something can happen like Volkswagen, where everybody thinks that, you know, it's the best we have, and then all of a sudden you're half your market cap. So these are the things that I think we should have more on our minds, and what role we can play to make the system work for more people and really move fast on that, without any doubt. And we have two wonderful opportunities to do that. We have the climate change agreements, where the world has clearly shown their commitment to decarbonize, where even President Trump is now saying that he would probably leave the Paris Agreement as it is. So we are getting more encouraging signs from the US even, the more we talk to them. And the other one is our Sustainable Development Goals, which are a wonderful framework on how we can make this a more inclusive business and a more inclusive world with enormous opportunities for business. The real reason that Lifebuoy is growing so fast is because we're doing hand washing and helping a child reach the age of 5. So running your business around these Sustainable Development Goals is going to be, I think, the bigger thing of the future. Investors asking companies to report around these goals. It's starting now small with Mark Carney's and Bloomberg's task force on carbon disclosure risk, which Graham is an active part of, but it will rapidly move to many other things. And I think companies need to worry about that, because it takes a long time to put it in, because it's hard work, it's difficult, it depends on the culture, the tone of the top, and unfortunately we don't have enough doing that. But if I were you, I'd increasingly make that part of your investment decisions. And I think as a company, we'd like to stay on the right side of that discussion, as you can imagine. So thanks again, thanks for your support, thanks for your time. I know it was a long and exhausting day, so we'll have some time to relax, and then we look forward to the dinner tonight. Marijn will share some of his thoughts with us, and we're doing it at Horton Manor. It's owned by a guy called Philip Cowan, who actually bought it from the Lever family when the estate was up for sale, but it's the original house that Lord Lever built and lived in. So if you have a chance to take a tour as well tonight, by all means do it. You can actually see, I'm sleeping there now, believe it or not, but Lord Lever never slept inside. He always slept outside. And amongst all his idiosyncrasies, this was one of them. So his bedroom and his bathtub, etc., are still outside now. And it's worth seeing. And then there are some other parts of the house you might want to just walk around in. But above all, we'll just have a good time, discuss a little bit more, and relax, and please say thank you. So hopefully, we'll see you later tonight. Thank you very much.
Thanks so much, Paul.